Okay, so thank you for coming. I'm teaching you today for an hour or so, uh, trading gaps. And with along the trading the gaps, I will explain to you different candles which are forming and how to read the support and resistance through the gaps, or through the technique. So once I explain, maybe you understand. So trading gaps. And this is not a complete material on gap because the gap is more than what I'm going to show you today. Anyway, so I start. So here's the chart of a market. Just look at the market. That this is the market, and it's an uptrending market. Maybe these are the first 4 days of beginning of the trend, and then the market gapped up. So the market gapped up. Now, when the market gaps up, there's a psychology behind. When the market gaps up, it creates a psychology in the minds of traders. So those traders who are in the trade already, in this trade, those who are not in the trade, and those who are uh, looking to enter. So those who are not in the trade and they see the gap, so they may not enter at this gap. So they may not enter at the gap. So where they want psychologically, if you think about it, if you put in the shoe of the other traders, when you look at this gap and you say, "Damn, you know, this is stock gapped up. I wish it comes down so that I can buy at the same price as these traders bought, right at this price." So it's like, you're waiting for the sale, and the sale happened, and you were not aware of, and then you wait for the sale to happen again. So you're waiting patiently. Maybe you set the price alert. And when price alert comes and the whatever you want to buy, uh, you get the alert, and then you say, okay, I'm going to buy that. So it's the same phenomena. So after the market gaps up, there are traders who are waiting for the same price. So now what price they will buy? So think about that. What price? The price at the close, which may be 100, or the price at the high, which could be 101, something like that, or maybe somewhere in between, somewhere in between. They don't mind. They're in a hurry. So when they see this candle forming, coming down, they go and start buying it. So what happened here after the market gaps up? And it also depends what else has happened before, how long this market is trending, whether this. So yeah, I'm showing you this chart. This could be exhaustion gap. This could be the beginning of a new trend. This could be a new catalyst. Something happened here. So you don't know. This is just a 4 bars I'm showing you. So what else has happened? Um, and what kind of news is here? What are the volume here? What else is going on in the market? So all that you need to put uh, together and then figure it out whether you want to take this gap at the open, or you want to wait for the pullback, or even when the market is pulling back, you're not interested in this trade. So after the market gaps up, two days of pullback, you can say it tried. The market tried to market gap. Actually, market gapped up again. So there's this gap occurred right here. The market gapped up, and then this market pulled back. So again, another black candle. So these are the resistance levels. So the market pulled back, and then the third day the market pulled back. So the third day market pulled back. So there could be some buying, some buyers are there at this price. So the market gapped up. Let's say the market closed at 100 and the market gapped up at 105. So they could be, and then the market went up to 107. So 105. So this. There may be some buying at 105 because this is where the market opened at the gap. So the market opened at the gap. There may be some other traders interested in buying at 105. So that's why the market is stopped right here. It pulled back a little bit and then it stopped here. Now this candle, this is a low. So on this day, the market fill the gap. So market fill the gap. The traders, those who were interested in buying at this price, let's say the hundred dollars, they came in and they bought. So once they buy, so the point I'm trying to make is that there are three kinds of support when the gap is created. The support could be the low of the gap. So this is the low of the gap. This could be another one support. Another support could be the midpoint of the gap, somewhere in the middle. So try to analyze this price, the middle of the gap, provided the gap distance is not wide. The gap distance is not wide between the close of the day, the previous day of the gap. So this between the distance between this and this is not wide, then this could be the support. If the distance is wide, then the midpoint could be the support. So look for the midpoint. So if the 100 is here and 105 here, so the midpoint would be 102.50. So the market may just pull back to 102.50 and then rise upward. The last support is either the high of the previous day close or the the close of this gap. So that's what exactly this market did, and touched and closed higher and then gap up, open here, and then it started to rise. So when the market is coming to fill the gap, uh, if you're watching at the daily chart, it won't help you. You need to look at the lower level chart. So remind yourself that lower level chart, all the way to 15-minute, all the way maybe to 5-minute chart, will give you the clue. So when the market is pulling back and you are interested in getting in, start set the alerts and start watching the 5-minute chart. And if the alert comes to you, so what kind of alert will come? Some kind of a low, that the price has touched the low, or price is breaking the support. So whatever is your alert you set, that alert will start coming to you, and then you fine tune. So when the market is trading in this zone, then you fine tune your entry by creating a narrow range, just like this range. So this is a day chart. This is a day chart. So you start creating this narrow lane in your lower level chart, maybe 5-minute or 15-minute chart. So 15-minute chart, you start creating the range, the lower range and high range. So if you create, when the market is coming down to the gap and you create the range, then you will get the alert. So if your alert system is how exactly do candlestick help a trader investor? He asked this question and then left. So, okay, all right. So he left. How does the candle help? And then left. So when you are watching anything on a day chart is just a day chart. It's just one candle. If this is a day chart, this is just one candle. You won't get much help from the day chart. Once you see the day chart is done, it's not going to move. You read the support, you read the resistance. It's that image is imprinted on your brain. So you don't need to look at the day chart for that symbol. You need to look at the lower level chart. So the lower level chart, flip your workspace into a lower level time frame, like 4 hour, 2 hour, 1 hour, 30-minute, 15-minute, 5-minute, and then you start paying attention to create a stalking process. So when you start to stalk the symbol and you have a proper setup, that's when you will be able to find the entry, proper entry right here, that the gap is filled and you take your chances. Worst comes worst, what will happen after you take the entry at this day? Worst comes worst, the stock comes down in this range and it start to go down. So if it starts to go down, you're out. So this is, and then when the market is trending up, then this area is your resistance. So you initiate your trade somewhere here, and then this is your resistance, these two black candles. So this is your resistance. So once this resistance is broken, then you have another clear sailing. So then you start analyzing the higher level. So look on the left side. So if you would look in this side, and you will know your targets. Your entry is here. Your targets are somewhere here on based on this other turning point. So somewhere here is your targets, and then you can manage this trade. Maybe add a little bit on um, every signal. So then you have to deploy other signals. Once you're in the trade, then what else you're looking for? Is the volume coming up? Is your other indicators lining up? Some kind of a trend line is being maintained on the pullback. So all that comes into play. So you're managing the trades, all right, and what news is coming. So gap in an uptrend. So gap and volume. So here's a chart. So the midpoint of a gap act as a support. So the point is the midpoint of the gap act as the three support. So I explained to you three support. The first support is this support, the low or the open of the gap. This is the first support, and this is a weak support. So if you're trying to enter in this zone, initiate little bit, very little. The second support comes in the midpoint. So if this if you see on your intraday chart that the midpoint is being supported, that's your another support. The last, which is a strong support, is somewhere at the close. And so this is what I do. When I see a gap, and then when you see the gap on a day chart, um, you can flip that symbol on an intraday, and you would maybe find that the gap is filled on an intraday basis. You don't have to. This is a day chart, but once the gap occurred, you flip that, start watching that symbol on your intraday, because there may be a fill same day, maybe in an hour later or 2 hour later. If the gap gets filled and the stock is starting to rise upward, that's where you get in. So look for the gap to be filled the same day, intraday level. So pay attention. So it's very important to be laser focused on what you're doing during the trading. If you are picking up the phone and running all the business, uh, then trading is your hobby, not the business. Gap and volume, midpoint of gap candle act as support or resistance. So here is a chart. There's a lot of things going on in this chart, so I explained to you. This candle, this is a hammer. So a lot of things going on behind this candle. So there's a different philosophy, different thing we read. So just look at this. There's a support here, the candle. Now there's a gap here, a minor gap, but this gap is not powerful because there's so much going on this side. So this gap is not as powerful because the candle is white candle, but it's not a like a large candle. Look at the volume here. So the gap occurred, but not much volume. So this is the volume bar. So not much volume. Look at the volume here. So that's why I tell you price along with the volume. So price along with the volume um, helps. So pay attention to the volume. So here are the buyers. Now look at the volume here. So there was a volume here along with the price action. So this volume is positive along with the price. Now the volume was very low, and then the volume declined. So this was the first. If you're an aggressive trader, this is your first entry. Now, and this is your second entry actually, right here, this gap. So this is your first entry. This is your second entry right here, adding more, and this is your final entry, third, with the bang. So the big bar, volume. So what happened? The professionals, those who believe the beauty lies in the eyes of the beholder, they bought here, then they bought it here, and then the news come out, big volume, and then others get in. So it's okay to get in here. Now this price, this is a support area. This is a support area right here. This is a support area here. So think about what is support. Support is the demand, and how the demand is created is created by the traders. And why the traders create the demand? Because they think it's a fair value that I want to buy at this price. I don't want to buy at this price. By the time they see this, maybe it's trading at 110, and this is 105, and this is 103. So they see 103 here, they see 105 here, and they see 110 here. So they rather want to buy. It's a regret. So um, there's so many emotions. One of the emotion is the strong, very strong emotion is the regret emotion. So regret sets in, and they say no. Doesn't matter how strong the stock is looking and is flying and all the news coming in, but because the regret, they want to buy at 103, so they will set the buy order right here somewhere in the middle. That's why it acts as a support. But when you're looking at this bar and you see this high volume, the first thing, instead of trying to analyze and paralyze and think about this and that, just get in, buy something like 50 shares or 10 shares, do something with that trade. You don't have to buy 1,000 shares right away. Who's saying, okay, you need to buy 1,000 shares at 103? No, just buy 50 shares. See it in front of you. It will show you the performance. It will show you some red, some green. 50 shares is okay. 50 shares, I'm in. At least I'm in. I'm emotionally involved. So it's like you are emotionally involved. Till you get in with 50 shares or 10 shares, you're not emotionally involved. You're involved in it now because you own it. So just get in. So you get in, you say, okay, I will see what is doing, because you're emotionally involved. You have 50 shares and it goes at a high price and it's closed right here. You say, damn, I wish I can buy some. So what then next day you're looking you're looking for the pullback, and the pullback is happening at the top range of the white candle. So you're looking for the pullback at the top range, which means that there is a minor selling going on, minor profit taking. So imagine why the profit taking is happening. Whereas you're trying to get in, and there are buyers who bought here at so the price here listed 42. They bought it for 42. You're trying to get in at 48.50, which is the top. So between 42 and 40, 50, the 8 point is like 25% gain. So these buyers who are selling here, they are up already 20-25%, whereas you're trying to make some money now. You have only 50 shares. So if few days gone by and the stock starts to do on sideways motion move with the small candles, and it's trading at the top of the range, then you know that this is not going down. So the midpoint, so draw the midpoint. So to learn to draw the line, I draw the line whole day. I'm drawing the line whole day. First of all, I'm putting the stock on my watch list. The moment I see something, I put it on my watch list, so it goes on my watch list. Then I go on the intraday level and immediately I draw the high for the day, low for the day. So I catch that immediately. It's like you bring that chicken into the cage, and then you worry about it. Okay, now let me dissect it. How I'm going to dissect? First thing is to bring that chicken in the cage, and the doors are locked. Once the door is locked, then you can leave that chicken. It will run in the middle somewhere. So you draw the high of the day, the low of the day, and then you immediately go and draw the line of the previous day close. So you just immediately tuck, you just capture that. No matter what, you get the pop-up. You go bring the coffee, and when you come back, you see the alert is popped up, and then you say, what? Okay, let me see. And then if you see something worthwhile, then you take action. Otherwise, you just reset it. So you keep resetting it for the midpoint, and the midpoint is not this is as close as it came. So sometimes you become so greedy that it didn't touch exactly the midpoint, and then the stock just rocketed upward. So another thing to pay attention is the volume is very low. So the price and the volume. So this price is means that there's a absorption of the selling going on. So whoever wants to sell, someone else is buying it. There's not much selling here. Look at the volume, and then boom, market start to rocket upward. So once the market does that and the volume rises, now this area is your support area. So this is your stop level. The market should not come here. Now again, you draw the midpoint. So this is another midpoint, and the market just rocketed upward, created another like a cannonball fired, and it broke up. Now it will do the same again, going on the sideway, and then move up for 2 days, then pull back. So the pullback, look for the 3 days of pullback. If the stock goes on a pullback mode for 3-4 days and it stays at the top range, it's telling you it's just a pullback, and it's not something to worry about. If it the market pulls back and it stays within the range. So you look at this three black candle, it stays in this range. It's just a pullback. And then the white candle, this you I mean look at this white candle, right? And then there's a volume is up, coming up. So whatever is being, someone is buying and somebody is selling it, and then the market rises upward. So this is the way the market does a stair step. So when you are at this stage, this is your stop loss. When you are at this stage, this is somewhere your stop loss. So you're you're buying up. You started with 50 shares right here on the day the market gapped up. Let's say you bought 50 shares, and maybe by the time you say, no, I want to buy more, so end up with 200 shares, and then you waited for a few more days, then you started buying another 150 shares. Don't buy 1,000 shares right there on day. Maybe you get lucky, and then the stock just keep going, but just buy 50 shares, and then get emotionally involved, and then you can build up your position and lower your. So a staircase like scaffolding in construction. So if you happen to be in construction, this is your support. So market just keep rising upward. So eventually the market will tell you some kind of a pullback will occur where you will say, okay, I'm out. Market will tell you it breaks down, or some news comes, or somebody like my friend says, somebody pinch somewhere and the market crash. So then you are out. So that's the way to do it. Slow, build up your position. Now here gap is support. So gap, when the market gaps up, it creates support. When the market gaps down, it creates resistance. So gap down creates resistance, gap up creates support. So now you need to play those support and resistance levels. So here is the market which is gapping up quite a lot of gaps here. So see here, there is a one gap here, which is not meaningful, but this gap is a meaningful gap. So this gap occurred. You see the window, big gap, but the candle is, if you look at this gap, the candle is so little that twinkle, twinkle, little star. And then you say, no, I'm not going to buy this gap. There's no follow through. But this candle may be telling you a lot. So the reason it's telling you a lot is look on the left side. So if you look on the left side of the gap, and it happened to be major resistance, and this gap occurred just above the resistance level. So it's like river. I give you the example of river. So there is a river and the dog is chasing you. The No Country for Old Men in the movie. So you jump in the river and you better, and the dog is chasing you, and you better stay on the other side, because on this side there are bad guys. You may be able to handle the dog, but you may not be able to handle the guy. Bad guys here. So it's like jump on the other side, so you better stay here. So they show in the movie the river is bringing that the good guy on this side. Oh no, I don't know. So this is what happened. Oh no, I'm here. Oh no, then he comes back. So this is where the support is. So this gap got filled because all these traders who did not buy here, they thought it is a tiny candle, is useless, and then they see another gap, they say, oh my goodness, I missed it. So all this, then the sell-off occurred, something happened here, and then the gap got filled. So this is the opportunity they are looking for, and then the market rise upward. So when the market rise upward, so there are some leftover traders, and if you are long in this market, you're paying attention to the where the gap is and where the gap got filled. So this is the area. So if I would draw the line here somewhere, I create a zone, immediately zone that the market pulls back. I need to pay attention to this zone. This zone should not be violated. And then this is something called harami candle, which is like a pregnant like pregnant woman. So this gives you the first indication that this market wants to go up, and it's holding this support. And then look at the market rocketed upward. So the action actually started here, actually here a little bit, but this was the buy signal. There was somebody who knew something, and This tiny candle, we ignored it. And how you can how you pay attention to the tiny candle. The tiny candle gives you a lot of there's a lot of story behind the tiny candles, and the tiny candle tells you the story if you can see what else has happened on the left side, because the tiny candle itself is not telling you anything. Sometimes you see, sometimes the market gaps up, and so your gap triggered, and then you look at that candle and you say no, it's useless, so you ignore it. But then it becomes a giant, it becomes big white candle. So what you do, you just the moment you spot the candle, you just draw the line, and it triggers, and then you pay attention to it intraday. So pay attention to it, and then you draw the line on the downside. When it pulls back, then you start paying attention to it. When it's coming down in trading in this range, you are getting alert. That's the point. You're getting alert, and then you're paying attention to what else is happening. So here is the buy. Here the selling is over, the buying is over. Somewhere there are some buyers here, sellers here. So the sellers came in here, and then the market tanked, and the market just stopped right here. So if you're watching this market on the downside and you're playing to the downside, you have shorts and puts, you need to pay attention to this area, because this is the area from where the market has rocketed. This market has done this move. So when the market is coming back in this area, the market may do the same action again. So if you're greedy and if you're not paying attention to what is happening, like the prices should blink in front of you. So maybe you have um, just a workspace for symbol just for the prices. So the way I've set up the 18 at any moment, the others I can watch more than 18, but there is one workspace I've set up, which is I have 18 major stocks in which I have position. I'm watching uh, blink by blink. So it's right in front of me, most 18 position, and others are on the other watch list. So if you're watching this and it's coming down, you should be getting alert that it's time to, you should have your sell order in advance. If you try to say, okay, I will, when the market comes here, then I will sell it and I will see what else is going on, maybe it will come here. No. So you're not being disciplined, you're being greedy, because there are other positions there. There's the risk is the more the stock is coming down, the more your risk is. uh, you have gains, but the more chances you have, you will uh, give back that gain. So be careful when it's reaching this zone. You need to be getting out before it makes a low. You should be getting out in this like a flush of the downside move. So don't worry about the last penny, and don't think about that the support will be broken and then I will make more money and whatnot. No, you get out. And if something else happened for 2-3 days in this range, let's say for 2-3 days, the stock does this thing on the sideway and then gives another breakdown, then you know you have another entry. So it's okay. Otherwise, the stock does this and you lose all your gains. So don't do that. Here is another example of a gap as support. So another example of gap as support. So here is bullish engulfing. So there's another big topic of this candle. So here is the buyer. Buyers are here, right here. And then there is a gap here, then another gap 2, and then the gap 3. So the gaps, you see how this gap got filled with this candle. So there was a gap here and the gap got filled right here, because the buyers who are having regret, remorse that they did not get in on the pullback. So look at this. So pay attention to these two candles. This candle is a reversal. So this is a reversal candle. So the traders are selling off, selling their position. So somewhere they bought here, they are selling here. And why they are selling here? Look on the left side. So some selling happened here. So if you are in this position, you would draw the line based on this zone. You will draw the line based on this zone. So if you're already in the trade and the first gap occurred right here, so you say, oh, thank God I'm in this trade. And then the second day the gap occurred. So now the gap occurred and the selling begins. So the gap, another gap occurred and selling began, and the selling began because this is the resistance zone. So the sellers are out, the buyers are out. Sorry. So this is a shooting star, you call it, or inverted hammer, whatever. But this is the resistance. So now, after this candle appeared, the the logic says if this market is bearish, it will gap down, or it will start to fall apart. And this is what happened in the morning, early morning. The trader saw that, because this is a market which sold off based on this resistance here. Whatever is the reason, we don't know what happened on that day. So the traders are expecting the market will gap down, or the market will sell off. And this is exactly what happened in the morning. um, let's say the market opened next day and the market gap down. So there would be some traders who market gap down, and they start to buy puts, or they start to short this, but they forgot they need to be patient. I don't know if you dissect this candle. This is the whole day candle. Maybe this gap down occurred only for 5 minutes, and then the market rapidly moved up. Maybe whole day the market was down, and then during the last 10 minutes the market moved up. So whatever happened, I don't know, because this is a day. Let's say this is a day chart, so you need to dissect this. But you see, here's the gap. It got filled. And then the market penetrated upward. So when the market is penetrating upward, and any candle which penetrates more than 50% into a bearish candle, it tells you to the sellers, buyers are telling the sellers that I am in, watch out. So this is what happened. This zone, this whole zone, this big, is the sellers zone. So this is where the sellers are. So when the market gap down, there may be some sellers. They want to sell further. Those who did not sell here, they are selling here. Those who saw this, they want to establish a new short position. And those who are smart, they waited for this position. They said, this is another opportunity for me to go long. So they supported this. And if you're watching this, and this reversal is taking place, and the volume bars is rising here, so you're getting confirmation of the volume, you're getting the confirmation of some other indicator. This is your another opportunity to add more to the position rather than close this position, because this candle is telling you this penetrated the resistance zone. So it's like if you draw the battlefield, halfway in, the buyers are halfway already inside the seller's zone. That's what happened, this candle. And then another next day, you see this black candle. So black candle came here. So this is the another resistance. So another resistance. So some leftover. So imagine the psychology of the traders. Those who left, they didn't sell. They want to sell here. They are having remorse that they didn't sell at the top. So let's say if they saw $5,000 profit here, they have 1,000 shares all the way, and they're seeing 5,000 profit here. They want to get exactly the 5,000 profit. So they start selling right at this high. They want to sell at the high. They don't want to sell here and there. So they sold off another 3-4 days. So this whole white candle act as a support. This whole is a demand zone. Is the whole zone is the buyer zone. This is where the buyers are living. So this is what happened. The market pulled back, it stayed in this whole white candle zone, and then the market rocketed upward. So the buying begins here. This is where the buyers are, the big buyers. They are here. Then they are here somewhere. And then there are some sellers here based on this. And then the buyers come in, and then the buyers, so gap occurred. So along the way, we need to think what else is happening, what has happened in the past or recent past, and then intraday, what is happening. Now here's some more example of gap as a support. So this is a gap. So anytime you see a gap, you say, this is a support area. Now how strong it is, there's some other things happen. Look at the volume. So in the gap area, analyze the volume. So this is another gap right here. The gap occurred. Now um, this candle, um, maybe this is your sell signal. So if you are in it in the trend, this gap occurred and there's no volume. So this may be your sell signal here. You sold at this price. and then the market became choppy. And so when the market became choppy and it's coming down, this area is acting as a support, because this market gapped up and a big white candle. So this area is acting as support. So market rose upward and then it just pulled back, and then is doing its thing. So this area, whole area is choppy area. But the real action was here, and this is your sell signal. Now the gap, so the gap which occurred in the congestion zone is more powerful. The gap which are occurring in from the congestion zone. So why the market gaps up from the congestion zone? Because the buyers and sellers are undecided. So they're just fighting with each other. It's like they are sitting somewhere under the, let's say under the tree or in the park or near the, and by the pool. They are just having a good time talking to each other, selling. Some is giving some shares, somebody is buying some shares. So they are just messing around with each other, and suddenly the news breaks out. So that's what happened. Then what kind of news? The some division is closed. They don't want to be in that business. They close that business, or they're closing some other in market in other country, or they're opening a market in another country, or something. A new product is being designed, or the CEO is fired, or a new CEO is hired. So whatever it is, a new thing happened in the market. So the gap occurred. So the moment gap occurred, and if you see this candle, this is not a good candle. So you notice this candle, you use this gap, but this is not a reason for you to buy, because when you look on the left side and you say, okay, this is too much resistance here. There's too much. This gap is not meaningful. So what I would do, I would just draw the line somewhere here. I will draw the line here on this high. I will draw another line here on this high. I'll just start taking out all the wicks, and I will start drawing the line. So I just draw the line here, this line, another line here, another line here, another line here. I draw like 4 or 5 lines. I draw another line here. So when the market is trading in this zone, my alerts are getting fired. So because they are so close, the lines are so close, I created so many uh, lines. So I created a big strong resistance. So when I look at my daily chart, I'll see there's a strong resistance zone. Why? Because all this market moving up and pulling back and creating this wick is telling me the sellers are there. So that's why you have a wick here, wick here, wick here, wick here, wick here. So all these are the sellers. So when I draw the line, I draw how many line I will draw? 1, 2, then I will draw 3, then I will draw 4, then I will draw 5. So on my chart, I will draw like 5 lines. And then if it starts to, and then I will draw some line here as a support. So I draw one line here, 5 resistance, 1 support. So during the day, I will start getting the signal. So this is a powerful buy signal right here. The market gapped up, gap down, fill the gap, market gap down. So I get the alert. So if I put the alert here, I will get some kind of alert here. So not only I'll draw the line here, I'll draw somewhere in the middle. So when the dog is swimming in the middle of the, I'm getting alarmed that okay, the dog is in the river. I better watch. So I will then decide what else I'm seeing and what else I'm feeling about it. So initiate a position as soon as I come, worst come worst, what will happen to me? Think about it. If I buy 50 shares, what will happen to me? The worst, I will not die. I will put another, I will immediately after buying 50 shares here, I'll draw the line here somewhere in the mid, in somewhere at the low. Worst come worst, 50 shares I bought, I draw the line and then I'm wrong. Okay, I'm wrong. But if I'm right and the market starts to move, so I buy another 25 shares, then I buy another 50 shares, then next day I'll buy another 40, 50 shares. So I piled up to initiate something in little bit here, then a little bit here in the middle, then at the close, maybe you buy some, then next day the market gap down. So you see the market gap down here, the market close here, the market gap down, and the market gap down exactly at the midpoint of this big bullish candle. So again, another signal that, okay, market gap down and start to rise. So when the market gap down and start to rise, I have another reason to buy. So I'm looking for another reason. I mean, like I'm getting some kind of excuse for coffee, morning coffee, then afternoon coffee, evening coffee, um, coffee before sleeping. I'm finding some excuse. So I'm finding some reason. What else I see it? So if I see the market gap down here, I do something. And when the market moves up here and take out the previous high, I do something. And then the market gaps up here, maybe I do something here. And then when the market starts to pull back, maybe I'm out here or here somewhere I'm out. I don't know. I don't know what else happened that day. Maybe other positions I have. So I'm out here, but I did something. 50 shares here, 75 shares here, 40 shares here, 30 shares here. I piled up my average cost. So I'm dollar cost average. So sometimes I'm buying at the higher price, sometimes I'm buying at the lower price. So do that. So look for the gap from the congestion zone. Same way, the gap down. So gap down. So this market gap down right here. So this market gap down. Maybe you initiated a short position. I don't know what else has happened here. So this gap down occurred. This is a breakdown gap. So this breakdown gap, if there is a volume here somewhere, then maybe I initiate a position here because this is a gap down. The market was trending in this zone. These three candles were looking bullish to me, but then market has started to drift. This was the support here, and then market drift lower and then gap down. So worst come worst, if I short this stock, worst come worst, what will happen? If the market gap down, and why I'm going short? So here's the reason. If this market gap down, why I'm going short? I'm going short because I see this is the zone and it market has broke away. So whenever the market breaks away from certain thing, that tells you something, either to the upside or the downside. So when the market breaks away from something, that's market is telling us something. And the worst come worst, I close the trade at a loss. So if this market gap down, it better not come in this zone because that's my reason. This is my reason to go short. So if this is my reason to go short, why I'm holding a position right here? If the market is traveling in this zone, why do you think market will go back here and then it will do again the same thing? No, the market will do this. So when this is my reason, then the reason is not valid if the market is trending here. So I short here, don't short 1,000 shares because you don't have any dry powder. Don't 1,000 shares, short it right away. Build the position. So for 3 days, if you shorted 1,000 shares for 3 days, you were biting your pinky because it's doing this, it's doing this, and then you worry about it that what will happen, and it can gap up, and then you will worry. So this is another reason to go short. Another reason. So if short here, then short here. 3 day, anytime the market gaps away, and then for 3 days it just goes on the sideway and trade in the upper zone for the gap. So trade in the upper zone. So it's traded in the upper zone. It didn't even fill the gap, and then another boom, another crash came. So some news came. So these were maybe they were short covering. Maybe they were trying to be hero and they're buying something. The heroes which the traders they buy on the earning news comes out and they become hero and they buy it, and the next day another big hero comes and then he starts selling. So don't be hero on this little candles. Wait for this move and then you short more, and then another day another gap. Okay, you have opportunity to short more because you can now. If you short here, then you don't, this market should not come in this zone. If you short here, the market should not travel in this zone. If you short here, the market should not come in this zone. So if you shorted here on this gap also, then your exit comes very next day. This white candles telling you the sentiment is over, the game is up. You need to close because the market gap down here too. So the market gap down here, the market gap down minor here, then the market gap down here. There's a gap here too, little gap, but it's little gap here. So market gapping down 1 2 3. So and then this is the fourth gap. So this fourth gap was the climax. No, the market found some reason. So it's like the music stopped. So when the music is stopped, you need to be out. So if you shorted on this, that's your last. If you shorted on this gap, that's the unit you will lose because this previous units making you money. This you shorted some here, you shorted some here, you shorted some here. So how many times you found the opportunity to short? In the final, you lost some. So you shorted here one time, then you shorted here 2 3 4 5. So you shorted here 5, and then you shorted here the 6th time. So sixth unit. So you're shorting, let's say, 200 shares, and you shorted 100 shares, and you shorted 50 shares, then 25 shares, then finally you reach 10 shares. And then in the 10 shares, it become the loser one. So when it becomes the loser, because there is a gap down reversal. So this is the gap down reversal. So when it gap down reversal and it takes out the previous candle, you say, okay, I'm out. So you close it. And then the market rocketed upward. You see here the gap, this gap fills some gap here, and then the market is doing this. So the buy actually, the big boys, the traders who made the sentiment change, they changed the sentiment on this one, and then the market rocketed upward. And if you're holding your short, you're seeing this from 5,500 to 7,000, and you're still holding the short from here. You're holding here. Now this one, so the gap also comes as a confirmation. So if you're already in a trade and based on some other reason, and then the market gap down, then you say, holy cow, you have further reason. But just be on alert that is not doing something opposite. So don't, when the market gaps down or gap up, you have to be on high alert for that position to for you to protect that position, because the market gapping down or gapping up, it can backfire on you. So it could be temporary. So here's the gap down. So you noted this. Now this is, if you draw, so it's very important for you to draw the trend lines, or upward sloping, downward sloping trend lines, horizontal line, support, resistance. So then you need to count how many times this is valid. The more time it touches, the more valid it is. So here's a gap down, then the market penetrated upward. So this is like a signal. Okay, this is the trend line broke to the upside, and I'm going to go long. So if you went long, the market filled the gap right here. This is the resistance. This is the resistance, and then the market just broke. So if you went long just because the market went on the other side of the downward sloping trend line, so the when the market goes above the downward sloping trend line is not as bullish when the market goes on the other side with the upward sloping. So upward sloping already, and the market goes on the other side of the upward sloping, because temporarily it went the other way. So that is a better position to go long than to go long on a downward sloping line. So this is a downward sloping. It's better to go on the short side. So this is where the signal came. It filled the gap and the signal came, and the market crashed. So gap as extra confirmation. So this gap is an extra confirmation of the trend line break. Now the same phenomena. So we can okay. So gap in a downtrend. People ask question, and then they don't get immediate answer. They leave. They just want to answer right away. Hey, this, and then they leave. Wait, I will answer at the end of the present. Teaching something. My thought is going through. I cannot answer your question. So look at this. So gap in a downtrend. So so same phenomena, the gap in the downtrend. So this market is gapping down. So when the market gaps down, a channel is created. So immediately when you see a gap down, you start drawing the line, because this gap is the resistance. This gap will act as a resistance. So why the resistance? So think about this. Why it's a resistance? So anyone who did not sell, their position, they would like, or anyone who did not buy, sorry, anyone who did not buy, did not sell, so did not sell. Anyone who did not sell, so think about this. Anyone who did not sell, they are seeing this on a gap down, so they are regretting. So what they will do, they will look for this uh, price to be filled, and then they will start selling. So when the market is moving up, and we are just focused on this trend, and we forget to um, analyze the gap on the left side, we get trapped. So when the market is, this looks like a bullish, this is a bullish entry right here. But this is not a powerful entry because a lot of reasons. This candle is not as powerful as some other. So this is not powerful. So there is a profit taking, the short covering going on. And when the gap gets filled, so when this kind of a move is occurring, this is some kind of a short covering is happening. Some buyers are here, but they are weak buyers. They are not strong buyers. And this is where the gap gets filled. And when the gap gets filled, this is a resistance. So if you initiated a position here, this is not a powerful buy signal. This is not a powerful buy signal compared to other buy signals. So you're looking for some kind of a fill here, and then another move down, another move down. So this market came here and almost filled the gap and crash. This is another buy signal. This one is a buy signal. So this is a buy signal because the buyers are here, and then you will look for another attempt to break the resistance. So somewhere in this zone, when the market comes, this is another confirmation for you that this market wants to go higher. The first attempt, the gap got filled, and then the pullback happened again. The market came down, but this is the second attempt. So that when the second attempt happens, all these they are gone. They are gone from here. So look for some kind of a dwindling move again, some kind of a move here a little bit, and then the market will take off. So the market will tell you it's taking off. It filled the gap again and it is taking off. So you will have plenty of chance to get in on this move. Now this is another one. So this is called two black gapping. So this market is in downtrend and this gap occurred. So gap occurred. So if you short on this gap, then the market should not come and trade in this zone. If the market start to trade in this zone, then this is not, you don't have any reason. Why would you hold if you shorted in this gap down? Why would you hold if the market is trading in this zone? You shouldn't be trading here. You should close this your position. Close this position. So when the gap down occurred, and then another big sell off, and the sell off, this is a powerful sell off, and the reason is, look at this. This is the close, and this is the open. So next day the market open and start to sell off right away without just a um, little bit of pullback to the upside, and then the sell-off begins, and it non-stop. After the gap, when the gap occurs, the size of the very next day, the size of the candle enlarges, whether to the upside or to the downside, is telling you the power of the downside move. There's a lot of sellers here. They some those who did not sell, they did not get, they did not understand the news. On this gap down, these guys, they did not understand the news. So imagine when the market gaps down and the big boys are there, and they come, they don't go home as soon as the 1 p.m. Pacific, okay, let's go for coffee. I'm sure they're not doing that. They are sitting down, they have a lot of stake. They're going into the conference room, they're talking, phones are ringing, and whatever. What think about that? What else is happening? So they unleash their sell program next day. They said, okay, get out. So they tell their traders to get out, open your sell program. So they're selling it. So this selling is evident. So if you are already in this trade short, let's say you like it and you shorted it, then the very next day, when you see this kind of move, why would you just sit on the sideline and just, I'm in profit? Why not add a little more on this, when you see it, especially when you open your intraday chart and you see the move. So you must get some kind of in your skills, you should get some kind of a more alerts, more reasons for you to say that, okay, I need to add more to the position because I'm already in the position, and I I'm lucky to see this big black candle forming intraday. So this is the daily chart. So if you look at the intraday chart, you would see the red bars coming in or black bars forming in, whatever is your coloring situation for the downside move. And then you should be adding more. So if you see further reason, then you add more. Further reason, you add more. Worst comes worst, the last unit you added. So if this is your target, you add it somewhere here, the last like 10 shares, and then all you just start to sell. So when the market is reaching a target somewhere here, you start to sell 50 shares, 100 shares. You just, you don't need to sell all everything. You just set your own little program and set the order for 100 shares. Okay, 100 I'm out, then 100 another out, then 100 I'm out. If you have piled up 1,000 shares, you don't have to sell all 1,000. Boom. No, don't do that. Just 100, 100, 100, 100, and you are out. So, and watch the 5-minute chart. So your exit protocol triggers, and then you are out. Gradually, you just scaled out. So do that. Here's the example of a gap as a resistance. So whenever the market gaps down, it creates a resistance. So on the way up, it will meet the resistance because there are some sellers waiting there. They are regretting. They did not sell at that price from where the market gap down. So they have a regret and they want to sell at that price. When the market gaps up, they have regret not buying it. So they have a buy order there. So the regret is playing role. So regret is a very strong emotion. So here is the something called hanging man. So this is a bearish signal, and then the market gap down. So when the market gaps down and it rallied, so the market big gap down and the market rallied. So those buyers who did not sell here somewhere, they unleashed their sell program right here. So the gap got filled because this is a whole resistance zone. On the way up, if you are holding a long position, and let's say you bought it here somewhere and you saw this gap down, this is your another opportunity to sell in this zone. So this is what they did. They sold. And remember I told you before that after this, expect more selling. So this is what happened. The selling came. But if the selling doesn't come, because this is where the sellers are, so they are hidden there, they are sellers. So if the sellers are here and the buyers take over this sellers zone, then it means this market is very powerful. So you need to join the market where the sellers are being overrun by the buyers. So you go in the market where the buyers are there in more than the sellers. So anytime the gap is filled and the market rise, you need to get in. Anytime the market doesn't come back, you need to get, start shorting it. So this is where they found another opportunity to sell. They sold here. Remember, after 1 p.m. Pacific, they must have met in the meet. They have a meeting. They say, okay, we need to sell. So they sell. They sell. Everybody sell. And then there are no buyers here. And the market just went. The sell signal came here where the arrow is drawn. The sell is here. Now this is another one, same slide. So this is what I explained to you already. Now this one is another big sell signal, big sell signal here. Market opened here. Market opened here, big gap. So imagine this candle in the morning, maybe a market close here one day, let's say Thursday, market close here at 14, and it gapped here somewhere at 16. So big gap, and then it went to 1750 or something, and then a pullback, and it closed below the low. So this is what kind of Microsoft did. So we had a Microsoft long position, and it gapped up big time to the upside. It was a big gap, and then it started to come down. That's where if you see this, if you have a long position in Microsoft and you saw the gap, so if you look at the daily chart of the Microsoft, you saw a big gap. So it was a huge gap, and before Microsoft was uptrending, and the news comes out, so you sell, so you are out. Then when you are out, and then you start drawing the line on your intraday chart and start seeing what else is happening. So if you buy the puts, worst come worst, what will happen? You're out here. If Microsoft reverses to the upside, you will be out. So I turned the bullish position in the Microsoft into the bearish by buying puts, and the next day the Microsoft just came down enough to make 60-70% gains in the option. So when you see this kind of a move, you immediately turn into first of all, you need to close your long position if you have. Don't look for it to buy. long. You're looking for what else is going on during the day. Pay attention to the volume on an intraday chart, and then establish a short position, and start drawing the line as soon as the market opens. Start drawing the line. So this will be your line at here. That this is my high. This is my open here. Somewhere I start drawing the line, and on an intraday chart, and the market I keep seeing going down, going down. Okay, now I need to buy some puts. Worst come worst, I will be and then when you buy the puts, look for the strike. Look for the strike where the open interest there. Look for the strike to match some support level. That's where it's going. So when that option hits that strike, your maximum at the money, that's where you will be making the most gain. And when you're trading for this kind of situation, if you're buying out of the after the money puts, you're I know out of the money puts is risky, but you don't want to buy when the intraday reversal is happening. You don't want to buy way in the money puts, and you don't need to buy too much time. I want to buy 90-day time. No, you don't need to buy 90-day time. You don't need to buy way in the money. You may buy in the money because you're looking for a quick move. If you're right, you're right next day, or second day you will be right, because markets have gapped up on some news, and now it's pulling back. So you will be right tomorrow. You should be right tomorrow. Otherwise, why would you think that the 90 days from now Microsoft will come down? Why you have to pay for that much for the time? Why you have to pay for 90 days? You buy 2 3 weeks, the result will be out tomorrow or the day after tomorrow. So and then other traders, the wisdom of crowd. So other traders, those who are smart, they are trading like that. You see them where the volume is, which strike is the volume, and then you analyze that strike with the targets here, with the resistance, with the support, and then you say, you see how smart they are. The traders are smart. They are trading, they're buying the option based on where they expect the market to pull back, or where they expect the market to go up. That's where they are buying it. So they're making a lot of money. So this pullback, you don't need to buy 90 days of option. Don't buy 90-day option. Is useless for this kind of a trading, where you're looking for the gap up and then the gap down and the reversal. So you don't need to buy too much time. Result will be out tomorrow. Otherwise, you don't need to wait 90 days for the results. Here's another example of 3 gaps and hanging man. So here's the gap, the first gap. So this is the gap occurred away from the zone. So whenever the gap occurred away from the zone, and you cannot time your entry, you just get in. If you plan to buy 500 shares, you just buy 50 shares, and you say, okay, I'll see what happens. And then when the market is trending on the sideway of the big bar, that market is telling you this market is bullish market, because it's trading on the side of the previous bullish bar. It's not trading way below here. So this is what the market did. It traded on a sideway, but it traded on the upper range of this gap bar for 5 6 days. 1 2 3 4 5 6, and then another move, then 2 days of up move, then another gap. So another gap. This is where the sellers came. So this will be your, after 2 or 3 gap, if you're in the market and you're seeing consecutive gap, you have to have some limit to your greed, and you say, okay, enough. Three gaps, and then this gap is minor gap, not enough distance, but this is a powerful candle. This gap is distance is less, but look at this gap. This is a big gap. So even with this gap, you should be selling. You should be selling in this gap, not buying anything, because the one gap here, then the sideway motion, then gap here, then big gap, and then this is where you have to have some kind of a sell order and sell everything. So gap, sell it. Here's another example. So this kind of a candle is telling you the market is like a yo-yo market. So market cannot tell which way it wants to go, but you have some reason, something your bias. So when the market is yo-yo, then you say, what is my bias? Which way the market will eventually resolve? Which way, there's like, and then which way will this thing will end? So if the market is going down and this yo-yo happen, then you say this yo-yo will resolve to the upside, because this market was already down and then it is spinning. It's spinning, it's spinning. Buyers are cannot make the decide. The sellers cannot decide. Then they ultimately decide, okay, we settle here in the middle. So this is a low, this is a high. So this is all became a resistance zone. So all resistance and support zone. So it's like mix, resistance and support zone mix. So this is a big another topic. And then the market start to show some kind of a support. So it's showing the support here, and then the market gapped up. So this is your another opportunity. So if you buy here a little bit, you don't buy a lot, you just initiate a little position here, then you start nibbling here, and this is your buy signal. So gap up, breakout gap. So this is a breakout gap. This gap is telling you that the market has decided. So the market was confused here. Market was confused. I'm sure the professionals, the big boys are not confused. It's the little guys who are confused. They don't know. But the deep pocket, they are not confused. They know what they're doing. They're buying. They have all the means to know. So they bought it here. So all the other guys, they are just spinning around their head, and the other big boys, they are buying it here. And this market has decided. So they bought it here in this zone, and other guys, they are coming in here. And I'm sure the other with the deep pocket, they are coming in here. And then you sell here. You don't need to, when you see like this kind of action, you just sell. But the buy came here and here on this gap. So if this gap up occur and you say, no, I'm not going to buy, I will wait for the pullback. The pullback did not come. So if you had allocated to buy 500 shares and you didn't even buy 50 shares, then you saw this. So then you saw this, and then 50 shares, you didn't even buy 50 shares, and you, because you agreed. So buy at least 50 shares. What comes, what will happen? The market will pull back, and then you will buy another 50 shares here, or 75 shares or something here. Another one, another gap. So here's a little gap here, and then the market pulled back for 2-3 days, and midpoint. So you see midpoint somewhere here, and then the market rocketed upward. So this gap was one buy. It's away from the congestion zone. So this gap is one buy away from the congestion zone, and then another buy signal comes, and then market is telling you here, market wants to go down, not up, because all this market goes up, comes down, go up, come down. So this is where you say, okay, I'm out. I need to sell. But when the market goes up, cannot make the decision. So when the market start doing like this, you don't need to be in that market, because the market will do this. Market will do this. I think the Starbucks did that. So if you look at the daily chart, the Starbucks did this. Now there are three kinds of gap. I will explain to you quickly. So whenever we are looking at the gap, we need to remind ourselves what kind of a gap it is. So there are three kinds of gap: a breakaway gap, runaway gap, and then there is something called exhaustion gap. So pay attention to the three types of gap: breakaway gap, runaway gap, and the exhaustion gap. So traders don't pay attention to these kind of gaps, and then they get caught. So look at this chart. This chart is not a candle, it's just a bar. So look at this. If you're looking at this, so this is a congestion zone. So this is where they are hanging out by the pool, buying and selling, buying and selling, buying and selling, up and down, up and down. So this market is actually telling you something, that is creating a multiple bottoms here. So it's inverted mountain. So this chart is an inverted mountain. So inverted mountain is a bullish chart. The mountain, regular mountain, the one you see like a mountain, is a bearish chart. The inverted mountain is a bullish chart. So when I see this kind, I need to start drawing the line. So you start drawing the line. You draw the line here. When you see another low, you draw the line here. So you would draw several lines for each low of the day, or close of the day, or open of the day. You will draw a bunch of lines here, and you will draw a bunch of lines here. Whenever you see, let's say you are analyzing this chart and you see this, okay, you say, okay, this chart, this chart is just wasting my time. I just draw the line and forget about it. So you draw the line, you draw the line again, another day you saw the line and draw the line, and then boom, you see a gap up occurred. So when all lines are broken simultaneously, so when the alert is coming and you're seeing it, and you have drawn so many lines, so you must have a reason to draw the line. So you drew the line, and then you see the gap. So this is a breakaway gap. The market decided to ultimately break away. So whenever the market decides to distance itself, whether to the upside or to the downside, it's telling you something. The market is in urgent mode. Market is in urgent mode. So you would initiate a long position on the breakaway, and then you would draw the line from where the market break away. You will draw the line, that's your support, and then you will draw another line where the market open, so that's another support, and then you will start drawing the line. You will draw the line at the close of the day, and then what happened? This market pull back exactly to the low or the open of the gap, and then the market takes off. So this is your another buy signal when the market takes off. And the market is going up. So then market rested, and then the market gapped up. So that's a runaway gap, and then the exhaustion gap. So let me explain to you the breakaway gap. So what you will be looking at when you see the market gaps away from the congestion zone. So remember, it's a beginning of some significant move, and you're going to miss it. So if you are having some kind of a greediness. So greediness is cheapness. Call it cheapness. So if you're trying to be cheap, yeah, no, I will buy when it pulls back. You will never be able to buy. So get in at least when you see this kind of a sentiment change, you buy 50 shares or 100 shares, something. So you're emotionally involved in it. So you buy that because there is some significant move has occurred. Something has come at this today, some news maybe you're not aware of, and you will know 3 days later why the market was moving. Market knows more than us. So some significant move has occurred, some major basing pattern completed, some breaking of a major trend line. So there could be a trend line. If you're drawing the trend line, so the trend line would be a downward sloping trend line. So the market maybe fell from this side all the way from here, and it fell, and it tried, and then it just, um, this is a trend line or downward sloping trend line, and then the market just gapped above on the other side of the trend line. So that's your another clue. Heavy volume. So if you draw the volume bars here, you see the volume building up. So you're doing the analysis of the volume. Volume is validating the price move. There is no anomaly occurring in the volume. So you do the volume analysis. Breakaway gap do not get filled easily. So the if it gets filled easily, that's your another opportunity. So because this is a breakaway gap, so breakaway gap don't come. The market doesn't give you the chance to wait for the market to tell you, okay, I will wait for you. You come down, I'm coming down here, and then you buy me. No, so because it's a grape, the breakaway gap, the volume is huge. You just get in a little bit. At least you are emotionally involved. You have 50 shares. Worst come worst, your stop is somewhere here. Forget you're stopped out. But if the market does this or the pullback, you buy another 50 shares, and then when this market starts to move up and break out some resistance, then you are adding more to the position. So significant move occurred, some news came, major basing pattern completed, breaking of a major trend line. If it's a downward sloping and you see it, there's a heavy volume building up, there's a news here, there's a lot of activity in the options, and then you can analyze the strike, the month where the traders think the market is going. Gap occurs as support areas for future correction. So gaps are occurring uh, to the support area. Now I'll explain to you yeah, so this is a breakaway gap chart. So this is a breakaway. Now I'll explain to you the runaway. So the runaway gap is this. So the market moved up and then it's resting. So some profit taking is happening, and the market has established a strong uptrend. So you can see it on the chart, and then it does another leap forward. So another move up. So it's still the market is positive. So another gap occurred. So look at the volume again. So there's another second chance. The market is moving up. So what is happening? Market leap forward, another catalyst. So some other news is coming. And then the volume is low. The volume is not as high as the breakaway gap. And then where you see this gap will move if you're trying to estimate. Let's say it's easy to understand the target when the market has traveled to the area or the territory where it has traded before, but it's hard to figure it out the target where it's going if it has not traveled in that zone before. So this may be a 52-week high, something, a new high. So when that happens, then you measure this distance from the gap occurred to where the gap started. So just calculate for your rough estimate. So do the measure. So that's why it's called measured move, measured gap. You just calculate that previously the gap started here and now this gap is starting here. So take the distance, this distance from here, and then you expect the same distance for rough estimate that you expect the market will move up. So if the gap occurred from 100 to 110 and then another gap, then you add 10-point move, then you add another 10 points. So it's going to 120 just for your estimate. And then you will decide what will happen. It's a long way from 110 to 120, but that gives you an idea where the market is going, because market will tell you where it's going and where it wants to stop. So now the last one is the exhaustion gap. So then let's say another gap occurred. So this time the gap will be, the candle will be small, the volume will be low. It's the last gap, and that's where you need to analyze it. This is the last gap. This may be like I explained to you in a way that you go to the hotel lobby or some office, and then you push the elevator. They tell you you're going to 150th floor, but when you look at the elevator, it's going only to 100th floor. So you take that elevator to 100th floor, and then you get out, and then you take another elevator, and then you go to the penthouse, so the top floor. So that's where the exhaustion is, going to the penthouse, and then twinkle twinkle little star, and then it dies over there. So that's where you need to get out. So when you see a twinkle star, little star, and the volume is low, that's, if you are in the trade, you need to get out from that trade. That's it. Ask question later, get out first. So low volume, the last move, and usually most likely it will pull back. So buying the puts at that time is better than buying the calls or staying in the long position. So what will happen? Significant correction can happen. And then if so window open and window close. So what happened? So this is the exhaustion gap right here. So this is like one elevator. You went on the elevator, like let's say 100th floor, and then you took another elevator to 200th floor, and then this floor is only 203. So this was from 100 to 200, 200 to 300, and this is like 303, and then there's no volume, nothing, and it's just market is sitting there. So that's the last one, and then you get out. What will happen the next few days? The market will tell you that it's not going up, or maybe it's going to another level. So you start drawing uh, the lows and the highs, the lows and the highs. And if you see for 3-4 days, the lows and the highs are just close by here and it's in the sideway, that market is telling you that there's a distribution going on. And then you want to, uh, if you're aggressive, you can establish a short position or buy some puts, and you can buy out of the money puts. But if you're not sure, then you just stay away from the market. And if the market, so you start drawing, so I'm drawing the lines here. So I'm drawing the line here on top, all the highs and the lows. I'm drawing the line here. And then I draw the line of so this is what happened to, let's say, to the Microsoft. So I'm drawing the line based on the low, based on the open of the candle. So based on the open of the candle, based on the low of the candle, based on the high. So every day I'm drawing the line. So I have a bunch of lines on my daily chart, and I'm just waiting. And next day, let's say any day, the market gaps down. So when the market gaps down, is getting away from. So this is another very powerful sell signal, because the market doesn't have any reason to gap down after gapping up. So when the market gaps up and then gaps down, and it's exhaustion gap, is is telling you the sentiment has changed. Now the market is going down, and usually the market will come down to where it has started. The runaway gap started. So it's coming down to this level. It will do its thing. It will um, deceive you in between. it will deceive you in between. Somewhere here, it will do a lot of tricks on the way down. Eventually, it's coming down to this level because it broke away from the gap. And that's why it's called island reversal, because it created an island. It gapped up and it gapped down. Even for island, it doesn't have to be the next day. It can be 5 days, 6 days, 7 days, but the market has created an island. So the market created an island. So look at this. Let's say if the market gaps down here or gap down here and then reverse up. So if it gap down here and reverse to the upside, there's another, I will another draw the line here to create another channel. So I create channels and then I get the alert. So you create the channel, you say, okay, this is the high. The market should never, if you are short in this market, the market should not come in this zone. If you short here on this bar, the market has no reason to travel in this zone. And if market is come back here in this zone, you should be reversing your short position. What else is going on? You evaluate and then you have to reverse your short position and join, because the sentiment has changed and the market has found another elevator. It's like another 100 elevator. I didn't see it. I thought this is it. No, the market may take off. So just don't think the market gap down and then it has to come here. No, if the market travels in this zone, it's creating another 100 floor. It's going another level. And that level, you forget to look at, you forgot to look at the weekly chart. You forgot to look at the monthly chart. You forgot to look at the news. It has created another level. So Apple is doing it. Apple is coming down to 162. It tried to break, so it did not. Now it's 162, 163. Apple is crashing. So I'm just telling you now, 162, 163 for Apple. So this this is the Apple, and the Apple is coming here. So look at the weekly chart, look at the monthly chart. Sometimes we forget to look at. So the measured gap to downside is the same way, the way you analyze the distance from breakaway gap to the runaway gap. When the downside gap occurred, so you analyze it, then how much the market has traveled before from the runaway gap. The same distance you can apply, that this is the way the market is, the same distance the market is going. So when I do the analysis, I see Apple going to 160 to 163. So major gap to the downside. Now another one is, there's something called 3 rising gap and 3 falling gap. So usually they say the market, if the market gap up 3 times, that the third time could be the last gap, or the market gap down 3 times, that the third gap could be the last gap. So in this chart, I'm showing you, there's a one gap one occurred here. So gap from here to here. So as soon as the gap occurred, and these gaps, so don't you can, when you see the gap, you see it on a day chart. So you see on the day chart, or when you look at the stock which is moving up, and you say, oh, look, this is looking good, and then you forgot to flip the intraday chart to see that the stock closed way below yesterday, and it's and it has gapped up, and that big gap is clear on your 30-minute chart, which is not clear on maybe on a day chart. So pay attention to the intraday chart, and you say, oh no, look at it gap big on a 30-minute chart. The gap is really looking big, and then a lot of things are clear. It's like the lane is wide, and you can see through. On a day chart, you're focusing on a narrow basis. On an intraday chart, 30-minute, 45-minute, 90-minute, you can clearly see all the twist and turn. That's why I said twist and turn. So look at all the twist and turn. So this is the one gap occurred, this is a gap, and then the market closed somewhere here, let's say after 1 day, 2 day, 3 day. So then another gap occurred. So this is a gap 2. So this is the breakaway gap, this is the runaway gap, and then this may be the exhaustion gap. So this may be the exhaustion gap. So this is a penthouse. So think about it, this is a penthouse, this is a one elevator, this is another elevator, and then the market went to the penthouse. So when the market is entered the penthouse, the way overbought level, and after the exhaustion gap, the traders are trapped. They try to buy into. So that's what we get deceived. Like I don't know, some way of getting deceived at this level. We get deceived at this level. We get greedy and we try to buy because we are having regret of not buying here, not buying here. Look at this chart. I didn't buy here. I didn't buy. Okay, I buy here. So instead of selling, we are buying here. So don't do that. This is what happened. So now you have to be flexible. So when the market gaps down, let's say the market gap down and fill the gap, so market have no reason after gapping down and filling this gap to come back in this zone, come back to the penthouse. It's like, okay, bad boy, you're out of the party, you're thrown out. So this bad boy should not come back to the penthouse for the party. It should not. If it's coming back, it means the market is going to take off again. So it should come back here to fill the gap somewhere here, because this is a runaway gap. The market should pull back into this runaway gap and fill. If it's not coming back and is you see some kind of a move up, so the strong trending stock, the one which have a lot of money behind, lot of buying power, they do that. They just drop a little bit, fill the gap, and then they start slowly they start filling the gap, and then they like sneak in behind you. They come here, slow little candle, then they slow little candle here, then they come here, they sit here on top a little bit, and then they start to move up. This is where you say, okay, I know now. You fill the gap and now you want to take off. So you are creating another 100 floor. It's going to another level. So look at the weekly chart, look at the monthly chart to figure it out where it's going. If it has gone before there, it's going there. Same way, three falling gaps. So this is the gap, the first gap, market travel, then took another gap, gap two. So when gap three is occurring and there's create this kind of a pattern, the gap is filled. So when the gap is filled, what else has happened? The volume in the news, etc. So gap is filled. So what else has happened here? So only you know at that dip. So if the market fills a gap and reverses, market have no reason to come down. If the market is coming down and taking out the low after filling the gap, then this was a temporary. This buying was not powerful buy. Market should start to pull back, pull to the upside. Market should travel in this zone. If the market is traveling again in this zone and you buy here, is you have no reason to hold, because this is a breakaway. This market is creating another breakaway gap to the downside. So downside breakaway. So look for the break to the downside here in this zone. If the market is doing this kind of a breakaway in this zone after doing this action, market is telling you is creating like 10 more basement levels. So don't stay in that. You reverse your position to the short side. Now, so I explained to you this, the breakaway gap, the runaway gap, the exhaustion gap. Then I explained to you the downside breakaway gap, and there is an island reversal. So island reversal means um, the gap up and gap down. So it creates an island. You see there's an island here. This is an island. So now the island, some are very powerful island and some are weak island. So explain to you the powerful and the weak island, and then you will understand where you will pay attention and where you will not pay it, where you will think you can get this, you will be deceived if you go short. So trying to stay away from deception. So here it is. So this is an island. So in this market did like sideways motion, and then it broke. So market should never come up on this level. If the market is coming back here, okay, you need to close your short position. But here's another island reversal, which is called a Western Island reversal. So the Western Island reversal is the market does quick like somersault. Market the point one, the market closed here. It gapped up. So you see this gapped up. So imagine market gapped up. So it creates another candle. There's a big distance here. Then the market gaps down. So when the market gaps down and there is a gap here, like there is a like a Swiss canal. So there's a canal, the ship can float very easily. There's a pathway. The ship is coming here, and then you can clearly see the ship can flow through. So when that is happening, this is a powerful reversal, and it's called Western Island reversal. So the lows of the candle, the low of the candle 2 is not touching the high of the candle 3. So there is a clear break away from each other. So clear break. So it's like ship can float. So when you see a ship, when you're looking at the chart and you say, I can see the ship can float through. So you know this is a powerful breakaway gap downside. So you immediately you need to if you wait if you wait for this, like you can wait for 15 minutes 20 minutes, but if you see the sharp downside move coming in on a 15-minute bar and you can clearly see the volume, the more you wait, the more you are increasing your risk. And the reason is, and you are sacrificing your profit more you wait. So you have to be very quick in your move. The moment you see you recognize this gap, you have to really take action, because if you take action on this on a quick move down, the market, your stop is set on in this zone. The market should not come in this zone. So if you're buying here, you technically you need to if you buy on this bar, on this bar, um, still you need to wait for market to come back in this zone, fill this gap and come here. But if you buy this, if you go short on this bar, bar 3, your risk is the market should not come and travel in this zone of the candle 2. So this zone of candle 2 is the clear resistance level. So the more you wait, the more you are getting away from your stop loss. So it means when the trade lose, when it comes back to the candle 2 zone, you would lose a lot. So you have to be very quick in deciding that this is a island reversal and I need to get in. So you initiate, you short 50 shares. You don't have to short 1,000 shares. You just short 50 shares, and then you say, you look at the 15-minute bar constant. The market will tell you clearly on your 15-minute chart what it's doing. It's constantly creating a new low on a 15-minute chart, then another low, then another low, another low. So you know that this is the right short. If market just gap down a little bit and then it goes up, it start to dwindle on a 5-minute chart, and you see it's going up, then coming down, you don't want to be in that market, because you know that this is not a strong gap down. So the criteria is the market gaps up, gap up, and gap down. This gap down could be 2 3 days, 4 days, 5 days, but it has to be away from the lows of the other candle. So this candle is far away from the other candle. There could be multiple candles here. So this is the candle, this is the pattern you need to look for the gap down, because the profit is huge. And when you, as the trade is moving forward, your stop loss is not set here on this zone. Your stop loss is, you're figuring it out where your stop would be. Where is the pullback occurred? So when the pullback occurred and then the market dropped, then you set that stop there. And then when the market pulled back and came down and then pull back up, that's where your stop is going for if in case the market reverses and it's hit that pullback level again, then you know that, okay, this market is doing something and you need to now close your short position. So this ends today's session, and I will see you on maybe on Sunday. All right, thank you.